Hello, everyone. Welcome to Financial Freedom Through Apartment Investing. Um, I'm your host, Aaron Goins. The regular host is Mark Caesar. He cannot make it today, so he asked me to be his replacement. So I'm honored to be the guest host today, and I'm honored to have a Q&A session with our guest speaker, Mr. Adam Doran. How you doing, sir?
Hey, Aaron, I'm doing well. It's good to be here. So thank you for hosting tonight.
Yeah, man. I was very excited. When Mark talked to me about it, and I was really excited about attending this meeting, just to hear different wealth strategies and things like that that you and your team do. So, man, I'm very excited. Um, Before we get started, is there any newbies on here? Is anybody who's the first time on this meetup? If it is, please unmute and introduce yourself to everybody.
Hi, this is my first time. I'm Francesca Burek and I live in Manhattan, and I'm very happy to be here and to hear what's going on tonight.
Thank you for coming, ma'am. And what is your interest in real estate?
I've always had an interest in real estate, and years ago I was going to invest in Florida, but none of the properties panned out.
Mhm.
And I looked in Bushwick at one point, and those didn't pan out. So I've had a lot of things that didn't pan out.
Okay. Well, all I can say is that keep on trying. I think real estate is a great tool
Yeah.
to build wealth, and you have plenty of people on this meetup who has experience who can help you out. So please network with others. We're gonna have breakout rooms in a little bit, and please network with others. I think people can provide you a lot of information and a lot of help.
Thank you.
Thank you.
I'm going off because I have to eat my dinner. I didn't get to eat my dinner yet. So that's why I'm not on video. Otherwise I would be.
Oh, no problem, ma'am. Thank you so much for coming. Anybody else? What's up, Janelle? How you doing?
Good, thank you. I had to get myself off mute. How are you?
Good. How you doing? We got to set up a meeting very soon.
Yes. Thank you for reaching out. I'm looking forward to talking.
Yeah, absolutely. So we definitely talk offline and set up a chat.
Yes, for sure.
Yeah.
I'm looking forward to this talk tonight. I missed the very first part of what you said, but I know it's going to be good conversation tonight. So thank you to our guest speaker.
Yeah, absolutely. Is there anybody else who is new on this meetup? Okay. So Adam, man, I'm not going to ruin your introduction. Can you please introduce yourself to everybody, please?
Hi, guys. My name is Adam Doran. I'm in Kansas City, which is the city you see behind me here, but have friends in real estate around the country. So I invest in multifamily real estate as a passive investor or limited partner. And I'm always looking to make connections along that vein. My full-time career is I am a wealth advisor specializing in capital strategies for real estate investors and helping those who are high income, high net worth build tax-free wealth. That's kind of the short version. So what we're going to talk about tonight is a particular strategy as it relates to how you can support your real estate investing through what I think is a pretty unique capital strategy, and just get the wheels turning about how you can be a little creative to really maximize the use of every dollar.
Yeah, absolutely, man. I'm very excited. So let's dig in. So as a real estate investor, I think a lot of times, one of the things we got to do is try to find a property, get a deal, raise capital, make sure you have asset protection around this. But there's other strategies as well. And could you just apply how your strategy includes with apartment investing?
Yeah. So I think if you're a successful real estate investor, over time you start to have some good problems. One of those good problems is you have large lump sums of cash that come into your possession, and you need to store cash in a safe place. And ideally, it needs to remain liquid. And ideally, you don't want to subject that cash to downside loss, but at the same time, you want it to be productive, to not just be sitting there in, for example, a bank account. And so solving that, and then also solving the issue of, like you mentioned, Aaron, asset protection and insulating your dollars, either from whether that would be raising tax rates or whether that would be creditors that might come after you if somebody would sue you. And so we have a way to creatively deal with all of that.
That's cool right there. I think that's excellent, man. What is the first thing you think they should do once you have some extra money? What is the first thing you think they should do, and how that relates to you?
Yeah, well, I would say, and if you want, Aaron, too, I've got a PowerPoint ready, or if you were wanting to make this more of a casual Q&A, we can do it that way. But the one thing I like about having something visual to share is sometimes that can be a little more meaningful. But to answer your question directly, I would say there are some asset classes out there that are maybe not what we would consider traditional asset class. And one of those actually is permanent life insurance, interestingly enough. And the reason that that's an interesting asset class when it comes to capital strategy is because it's afforded pretty much all the same advantages that something like a Roth IRA is afforded through the tax code. But it comes with some add-on benefits as well that a Roth IRA can't offer. One of the key ones being, before you're 59 and a half, you actually can access your money and use it however you choose to. Presumably it would be for your real estate deals, but you can use it however you choose to. Another one of the reasons is with a Roth IRA, if you store your money in there, there's nothing wrong with that. I have a self-directed Roth, so I make use of that strategy. But in order for that money to grow, I have to subject it to risk. And so it would be nice to have an account where I could put money and know that it's going to grow without having to take any risk. So those are a couple of reasons why we look at life insurance as an asset class to maybe support your capital strategy or support your real estate investing.
Right. And please share. You can share if you want presentation.
Yeah, absolutely. And my thought, if you guys are okay with it, I can kind of zoom through like a quick overview, maybe take 15, 20 minutes doing that, and then do Q&A on the back end. I'm happy for people to type questions in the chat and whatnot, but it would be cool if I could just get through it quickly and then we could hit the questions. Would that be okay with you guys? You okay with that format?
Yes. Yeah, absolutely.
Okay. Awesome. So let me do a screen share here real quick. All right, you guys all see our main slide there that says capital strategy for the real estate investor? Head nods. Okay, good deal. So two prime reasons I think most of us are in real estate. And by the way, real quick before I start, I noticed Jim and Erickson and Vinky. So I'm glad that you all are here. I recognize you guys. It's great to see you. This may be a repeat exposure to some information you all have seen. So glad to have you here and participate in the conversation, because maybe you guys can help generate some questions too as we move along. But I think there's two primary reasons that most of us get into real estate. One, financial freedom, obviously. But two, and probably more importantly, is it really comes down to wanting to have more time. I mean, that's what all of us are doing, is we're trying to replace a stream of income so that we have the time freedom to do what we want. So with that in mind, I think most of us on here have started proactively figuring out how we're going to solve that problem of time freedom. I think what can get in our way is maybe the questions we didn't think to ask, the blind spots. They could be lurking around the corner that we have a plan, we have a strategy. Obviously, our plans and strategies always require adjustment, but if anything is going to derail a plan, I've found it's the blind spots, the questions we forgot to ask. So I'm going to ask you 3 questions tonight, and we're going to address all 3 of them. First of all, when you think about where you store money, when you're, in between deals, is that money or is that capital insulated from market risk? In other words, if you put the money there, are you going to take a 30% haircut tomorrow? And then is it insulated against rising tax rates? Because presuming that money is in a taxable account, at some point down the road, you plan to take it out. Like, let's say it's a qualified retirement account. So if taxes double in the future, do you have a strategy to mitigate that, to what that would mean to your income? Question number 2 is, what's the cost of interrupting the growth of your capital? In other words, I'm assuming you have an account where you put your money and presumably you grow it while you're waiting for the next deal. Every time you have to take money out of that account and put it into the next deal, what's that cost of interrupting the growth of that account? And then number 3 is, and this is a question I ask all business owners, not just real estate investors, all business owners. When you think about your balance sheet and where your personal wealth is stored, is that concentrated within your business? In other words, if tomorrow the business ceased to operate for whatever reason, would it wipe out your balance sheet? And I think those are 3 key blind spots that those of us who are investing in real estate building wealth, we need to keep in mind. And it would be great if we had a strategy that could help us mitigate these. And so I'm going to go into that. So my objective tonight is show you a way that you actually can insulate your capital account from market risk and rising tax rates. Show you how you can enjoy uninterrupted growth on your capital account, and show you how you can accelerate the process of creating wealth by growing multiple assets at the same time. And that's the part of it that I get really excited about. So first off, from a tax standpoint, there's really 3 different accounts, 3 different account options we have. At least if you're in America doing your real estate investing thing, there's 3 places you can put cash. You can put it in a taxable account. And I would guess that for most of us, if we're warehousing cash to put it into a deal tomorrow, a lot of us are doing one of these taxable accounts, either savings, checking, brokerage, something like that. Then there's tax deferred accounts. I would say if you're not doing the first one, you're probably doing this one. And this is all our traditional retirement accounts you think of when you think of, you know, the different letters and numbers that the IRS puts on these accounts. So 401ks, 457s, 403bs, all that fun stuff. And what's interesting is when someone comes into my office or we meet for the first time over Zoom, what I find is more than likely 80% or more of their net worth is wrapped up in these first two types of accounts. But there's a third option. And the third option is a tax-free account. And I don't think the traditional financial planning field, traditional financial services professional, spend near enough time educating people on this third bucket of tax-free. In other words, I get my income, I pay my taxes on my income, I put it in this bucket, and I never have to worry about taxes again. And I don't understand why we don't spend more time on it, because if you've read the Wall Street Journal, Forbes, or any of those lately, somebody put in the chat, what are you seeing? What's going to happen to tax rates? Are they headed up? Are they headed down? I'm curious. Have you guys been reading about this? Because it's been all over the media, particularly since the new administration came into office, which, by the way, that's not a political statement. It's just a fact. It's been in the, I think up. Yeah, me too. I absolutely agree with you. And so if we believe tax rates are likely to go up, why wouldn't we spend more time focused on accumulating money in this tax-free bucket? And so we're going to spend time on a strategy that can get us there. And so 2 different options for that account. One, I'm sure you've all heard of Roth IRA, right? 3 big benefits there. I put the money in, it grows tax-free. In retirement, I can take it as income tax-free. And because it's a retirement account, it has some built-in asset protections. A couple limitations on that account. Like I had mentioned earlier, if I've got money in there, I've got to subject it to risk in order to make the account grow. There's income limits. You can make too much money to do a Roth. Now, yes, there's a way around that with backdoor Roth conversions. Not the topic of tonight's discussion, but generally speaking, that account is built to limit access. You can make too much money to make Roth contributions. You also are limited, you know, $6,000 a year, or if you're over 50, $7,000 a year. And actually, if somebody else has seen the new 2021 rates, correct me if I'm wrong, but I think they just went up to $6,500 and $7,500 this year. Also, you got restrictions on when you can take the money out, right? Age 59 and a half. And then the IRS knows about every dollar you put into that account. So the other option that I had mentioned earlier is this permanent life insurance, cash value life insurance, whole life insurance. Same 3 benefits up front. We can put money in, we can grow it technically tax deferred, but the way we structure it, we're going to do it tax free. We can take out tax-free income in retirement, and we've got the same built-in asset protections as our retirement accounts. What's really cool on this side, though, is I actually, once I put money in, know that it has a guaranteed upside, and I don't have to take any market risk to get that upside. There aren't any income limits. If you make $3 million a year or $3 100,000 a year or 30,000 a year, you can do it. And there aren't any restrictions on when you can start taking that money out. You don't have to be 59 and a half. And probably my two favorite parts of this is you don't report any of the dollars you put into this to the IRS. And you can actually use the money that's in the account and continue to earn interest and dividends on it while you're using the money. And that goes to my point of accelerating wealth creation by building multiple assets simultaneously. So real quick, because I'm sure a lot of you have heard of this at some level. If you've been in real estate for some time, it's becoming one of those topics of conversation of what do I do with my money when I'm waiting between deals? And a lot of people are out there marketing this. I want you to know that it's really critical that if you're going to look into the strategy and research it, that you make use of a professional and advisor who understands how to structure it properly, because there is a proper way to structure it. And what's really interesting and should get your attention if you're skeptical on this is that there's actually a minimum and maximum amount you can pay for a given amount of life insurance. So let's say $1 million death benefit. And what's interesting is the minimum amount is set by the insurance companies, but the maximum amount is set by the IRS. So does anybody have any thoughts? If you want to plug into chat, or you're welcome to just hop off mute for a second. Why do you think the IRS has any interest capping the amount of money that you would put into a life insurance contract? There can only be one reason. And the reason the IRS is exactly, there's tax benefits. Tax benefits. There's a special part of the IRC Internal Revenue Code. It's called Section 7702, and it talks about how you can structure life insurance in such a way that it accumulates cash and you don't have to pay taxes. So the IRS will let you do it, just like they'll let you do a Roth. They obviously cap the benefit. In other words, they say if you're going to put money into this, that's fine, but you've got to buy a certain portion of that has to be death benefit in order to justify it as a life insurance policy. So visually, let me give you a picture of what an improper structure would look like and a proper structure would look like if you're trying to use this as a capital account. So that line that the IRS delineates where they say, hey, if you're going to put, let's just say 24,000 a year into this account and have it be tax-free, that's fine, but you're going to have to buy $1 million of death benefit in order to stuff in the 24,000. And so that line's called the MEC limit, or the modified endowment contract. If you buy traditional whole life insurance, you're going to end up with a policy that looks like this. Your agent quoted you the lowest premium amount that they could to help you buy the most amount of death benefit for the least amount of dollars. And that's a life insurance policy. Nothing wrong with that if that's what you're trying to do. It's not going to accumulate a lot of cash. That cash nowhere near approaches the limit that the IRS sets. However, the work that I do on a daily basis with real estate investors is we flip that model on its head. And we say, I want to fit as much cash into this as I can and have it grow and be tax-free. But I'm not so interested in buying any more life insurance than I absolutely have to. And so that model is a total different paradigm where I'm limiting the amount of death benefit that I buy, reducing that, and I'm increasing the amount of cash that I'm dumping into the contract up to that IRS limit. So structure is everything. So just wanted to point that out, because if this is something you're researching, that's a really important piece of knowledge for you to know. By the way, in that little 1-2 minute segment we just covered right here on this slide, you now know more than about 90% of life insurance agents across the country. So congrats, you guys have got a better education on how to build whole life insurance. Happy to have more conversation on that at some other point, but I'm going to keep rolling for tonight. So instead of taking it from me, because I'm a specialist that specializes in this strategy, let's see some examples in real life of people who actually use this. Walt Disney, 1955, used a loan from his whole life insurance policy to fund the startup of Disneyland before he had convinced creditors that they should invest in his crazy theme park idea. Doris Christopher in 1980 in her Chicago kitchen started a company with a $3,000 loan from her husband's life insurance policy. She didn't have any other means at that time, so they took $3,000 out of the policy, started a company. She recently sold it for billions to Berkshire Hathaway, and that company would be the Pampered Chef. Our president, our sitting president right now, From his 2011 financial disclosure when he was vice president, you'll notice he listed under the assets and income column of his personal financial disclosure, he has 6 whole life insurance policies. Notice it's listed as assets and income. This is a tax-free asset that he is using for supplemental tax-free income. Jim Harbaugh, who coaches football at the University of Michigan, a big part of his compensation package is the form of permanent life insurance. I won't get into the details of that, but it's a fun sidebar conversation if you guys want to talk about it during the breakout session or else sometime over Zoom. But there's a reason for that, and the reason for it is it significantly reduces his taxes on his earnings today, and it provides his family tax-free income in retirement and after he's gone. Finally, the largest purchasers of whole life insurance are banks, and they use it to fund their executive bonuses, similar to how Mr. Harbaugh's compensated. Same deal. Basically, they can guarantee their employees a tax-free retirement with a safe asset that they don't have to report to the IRS. Okay, so now let's bring it to our world, real estate investing. I'm going to be buying deals throughout the years. I'm going to be building an asset portfolio of real estate. Over time, like I'd mentioned when we started talking, I'm going to have this nice problem of cash is going to be accumulating, and I got to figure out a place to put that cash while I'm in between opportunities. And when the deal flows, or excuse me, when the cash flow starts coming in from those deals, I got to have a place to put my cash. So this is a 40-year-old female real estate investor client of mine. She was already regularly within her fixed budget. She already was earmarking $2,000 a month into different savings vehicles and methods, okay? And we said, what if we take that same $2,000? So we're not creating a new expense on her income statement. That's not what we're doing. We're taking existing money in her picture each month and saying, what if we divert it to this asset that we're building with life insurance? And what if you use that as your capital account to support your real estate investing? And so we're going to show her putting $2,000 a month into that each year over a 25-year period from age 40 to 65. And here's what the account balance looks like each of those years up to 65. Now, that's just this particular cash account, right? This is her contributing the $2,000 a month. Now, let's remember the fact she wants to build a real estate portfolio. So we're going to start buying properties. So year 5, there's almost $83,000 in there. Age 45, she's going to deploy a $50,000 policy loan, taking $50,000 cash from there and plugging it into a down payment on a single family deal. Okay, that deal cash flows, or maybe she pays herself back through the cash flow, or maybe she does a refinance, maybe she does a fix and flip and sells it. So she puts the 50 grand back over a period of time, and it can be any period of time she chooses, 1 year, 3 years, 5 years, 10 years, doesn't matter. It's her asset. She can put the money back just like a savings account whenever she wants. At age 50, let's say she does $100,000 now because her balance is $217,437, $100,000 loan. Maybe this time it's a fourplex. Then again at age 55, and maybe this time it's $250,000 into a multifamily deal. And then over time that property cash flows, or she refis, pays herself back. At age 65, whether she kept putting the money into this account and just let it sit, or whether she cycled through $400,000 of capital in these 3 deals that I'm showing you, once she puts that money back at age 65, she still has the same amount, whether she let it sit or whether she used it multiple times. So there is no opportunity cost, and she does not interrupt the compounding growth of this account, even using the money to buy the real estate portfolio. So now at age 65, she's not only built the real estate portfolio, she's built the tax-free account on top of it. And by the way, that money could be used to supplement her retirement income. So let's take a look at what that looks like. From age 40 to 65, she contributed $600,000 to the account. Let's say she takes a tax-free stream of income age 71 to 90. In addition to all the other income she's receiving from the real estate portfolio, there's a little over $85,000 a year in tax-free income that she can draw. And by the way, she doesn't have to report that again to the IRS. In order to have that same stream of income out of a 401k or a traditional IRA, she would have had to withdraw $112,000 a year. Why? Because she has to pay taxes on it. And that's assuming today's tax rates. What if tax rates go up 10%? What if they double? With this strategy, you're insulated from that. So again, to my point from the beginning, are you insulated from a hike in tax rates? Furthermore, at the end of the line, assuming she dies at age 90, she's achieved over 1.6 million of tax-free income from this asset, but her family's still left with a legacy of a little over 900,000, which is also tax-free. Now, I thought one interesting comparison for you all, and I'm getting close to wrapping it up here, and then we'll go into Q&A, is I thought, what if I compared this to like a high interest savings account? Because I would say, you know, that's the natural cash account that a lot of people store cash for their business, is like a high interest business savings or money market. And so when I put together this example, the best one I could find online was a 1.6% savings account. So I felt like that was pretty competitive in today's interest rate environment. Obviously, we'd all like to make more than that, but for a savings account, not bad. So I did the same thing that we did with the policy, put in 600,000 over a 25-year period. And at age 65, the account value was at 782. So right there, you can see quite a bit lower than the cash value was on the whole life policy. If she started taking retirement income from that at age 71, like I just showed you in the last example, she would actually run out of money at age 79, and she would only receive 665, 626, which is less than what she started with. And the reason I said that is because I assumed we were also withdrawing from some sort of traditional pre-tax or taxable account. She's going to need money to pay the taxes, so we took the money from the savings account, and that's why there's less there. So again, there's the policy numbers, there's the policy income. And guys, this is what's powerful. This is the same money, the same 600 grand. So she was doing what she's going to do anyway. It's just a matter of two different accounts, two different vehicles. There's the opportunity cost. If she uses a savings account, uses those $400,000 on the 3 deals I showed you over the course of the 25 years, she misses out on over 122,000 in compounding interest. She's also going to pay taxes every year on the interest that she does earn because it's a taxable account. And she has significantly less retirement income and runs out at age 79 versus having more than enough to last her the rest of her life. And so the difference in retirement income, when you add that in, you literally can have a $1.1 million difference in your end result, depending on where you're storing capital. So that's what I wanted to show you to get the wheels turning tonight, is when I think about capital strategy, what kind of vehicles are available for me to really maximize the use of my money? Because the same money, same 600 grand, same time period, same activities, but a different result. So just to wrap up, you know, we said we'd show you how to insulate your capital from market risk and rising taxes. Said I was going to show you how you could enjoy uninterrupted growth of your capital account and how you could accelerate that process of building wealth by growing multiple assets simultaneously. So just ask yourself, with what I'm doing right now with where I'm storing cash for my real estate investing, am I insulated from market risk? And am I insulated if tax rates go up? What could I accomplish if my capital strategy allowed me to continue to grow and compound the account, even when I put money into my deals? And finally, with what I'm currently doing, can I build multiple assets simultaneously? Contact info for you guys real quick, and then I will, I'll stop the screen share here in a second, and we can go into Aaron if the normal format's Q&A or wherever you want to go next.
Definitely Q&A. Definitely, you know, please guys ask away.
I have a question for you, Adam.
Yeah.
What does it take to qualify for this this cash value life insurance, as far as
That's
health?
health.
Yeah.
Really, really good question, James, and probably the natural question, because, you know, like you said, it's life insurance. It requires some underwriting. So there are two primary factors, age and health. So if you're on here and you're thinking, well, I'm a little older, or if you're on here and you're thinking, well, you know, I've got some health stuff going on. The cool thing about this asset is the owner who controls the cash and funds the policy does not have to be the same as the insured person. So if you're one of those that's like, man, I don't know, I might be a little too old to get approved, or I've got type 2 diabetes, or something like that. Maybe you have a business partner, maybe you have kids, maybe you have a spouse, somebody in your life that maybe there would be an insurable interest, and we can have some flexibility and use that person as the insured. Great question, James.
So to follow up with that, if my daughter is going to get married and having a child, my grandchild, I can actually insure my grandchild she'd be the trust. How do you explain that? She'd be it'd be her policy, but I'd be running it until I can pass it on to her at a certain age.
Yeah, and actually you're thinking down the right path there. And what's actually pretty cool too, and again, this comes down to taxes and preserving family wealth. You could, in that scenario, James, create 3 generations of tax-free family wealth. First generation being you, because you own it, you control it. Let's say you're funding it, just like the example I showed you a few minutes ago. That's yours to use right here and now. Then someday down the road, you can do one of 2 things. You can either gift that policy to the insured person, your grandchild. So let's say your grandchild turns 20. You can gift it to them, no tax implications, no tax reporting. Then your grandchild takes it over. Someday down the road, they pass away, long time after you and I are gone. There's a death benefit that's tax-free attached to that policy, and that's going to go to their beneficiary. You have 3 generations of tax-free wealth you created.
It's great stuff.
Hi, Adam. This is Greg. My name is Greg. How you doing?
Good.
I want to thank you so much for the presentation, and I met with an individual several years ago who explained it to me, or at least attempted to explain it to me in a way that I can understand it. And I still was, and I'm still slightly a bit confused as well on how it works. But also, once I got with him and to identify what a startup was, at that time, at that point in my life, was a bit steeper than expected. What is that? I don't know if that's the usual startup price, or is it just his price, or his whatever company is going with. What is the normal startup price for an individual who's actually trying to get such life insurance?
Yeah, that's a really good question. So a couple thoughts on that, and I'm going to share with you guys kind of like a general thought, general opinion. You don't have to take it as gold. Take it with a grain of salt. My thought on this would be, first of all, the way we do it at my office is most of our clients have a significant amount of discretionary income each month. And most of them have some accumulated assets. And so we're usually doing one of 2 things. We are either reallocating existing money that's part of their discretionary money, and they're sending it different places in their budget anyway. So we're just reallocating dollars that are already there. Or we're transferring an asset from one place to another. So very frequently, we'll have somebody that's got, an old 401k or an old 403b or something like that. It's tax deferred. They're concerned about tax rates going up in the future and don't want that money to sit for the next 20 years and then have to pay taxes on all of it. So transitioning that asset just from one place to the other where it's not coming out of pocket. So to directly answer your question, this particular strategy, it's really hard to build a meaningful asset with less than, we'll say, $500 a month. It's hard to build a meaningful asset. And frankly, so that would be my thought. Did my internet go out there for a minute, Aaron?
Yeah, you went blank for
You're back.
So the short answer was, if somebody doesn't have at least, I would say, $500 a month in discretionary income, they probably shouldn't be looking at a strategy like this to begin with. But it gets more and more powerful the more money that you have that you're trying to find a home for and get it insulated from taxes.
Okay, thank you. Can I ask another question?
Yeah.
Okay, so with that strategy, and you said $500 a month, is it possible that an individual can start by putting a higher amount to begin with, to in order to actually have something to start the wheel moving.
Kind of like jump start it, like a lump sum.
Yes.
Yeah, that is possible, and that's something that I wouldn't just blanket statement and say, hey, yeah, that's a great idea. I would say that you would want to take some time, lay out your financial pieces of the puzzle on the table and be like, all right, here's my big picture. These are the assets I have. This is my, income versus expenses, and do the math and kind of design a couple sample policies and see if that works, and if it makes sense, and if it still gives you what you're looking for as far as, liquidity in the short term and those types of things.
Thank you, Adam.
These are good questions.
One other question I have, Adam.
Yeah.
So you've established, someone's established this life insurance policy. Now, as far as investing it into real estate opportunities, I know that it's some like self-directed solo Roth IRAs or IRAs. You can only invest passively in other deals. You can't put it into any deals that you're sponsoring. Is that similar to this type of vehicle?
I think what you're speaking to, James, is like prohibited transactions.
Exactly. Yes.
Yeah. So you don't have any of those issues because this is an asset that you own individually. It's not a qualified account. It plays by a different set of rules. So you literally have access to the money in there to use it however you want. For those of us on the call, we're planning to use it to support investing, like buying real estate. But if you wanted to, you could use it to take a Disney cruise. And there's no rules attached to that. So great question also. I saw Sonia typed in, instead of monthly, can we just start with 100K? Yes.
You answered that. I thought you answered that question though.
Well, yeah, exactly. The looking at it and looking at the math, because I'll tell you, Sonia, just with that kind of amount, once you understand the structure of these things, what you'd rather probably do is phase in $10,000 a year over a 10-year period. And there's a reason for that. But it's a little bit longer and more extended conversation than tonight's meeting. But that's probably how that kind of scenario would play out.
Awesome. Actually, since you just mentioned the unauthorized transaction. So is there not a creative way, perhaps, where one can actually be able to transition either the Roth IRA or the principles in which they put in a Roth IRA, which is actually the part you can actually withdraw, and actually use it to input into that and jumpstart it?
Yeah, there is. And I would say if you have money in a Roth, you probably don't want to move it because it's insulated from tax rates anyway. The more common scenario is we've got somebody with an old 401k or a traditional IRA and it's tax deferred still. And we can't get out of paying the taxes on that money, but we can get out of the penalties. And that's through a pretty unique arrangement called a 72T. It's not for everybody. It's not something that we just, if somebody comes in and is like, I got a 401k and I don't like it. Oh, okay, let's do this. It's well thought out. We run the math. We make sure we're going to put somebody in a better position, not a worse position. But there is actually a unique part of the tax code. It's called a 72T arrangement, where you can transition money from a tax deferred account over into tax free. And you still got to pay the taxes, but you don't have to do it all at one time, and you can get out of the penalties.
Anybody else got any questions for him? This is great stuff right here.
And of course, you have to be separated from the company that holds your 401k before you can do any of this restructuring, correct?
Yep. Yep.
Adam, this is Janelle. I had a question. A question that came up for me was when you were talking about taking the loan. You used the word taking the loan out, and when you said that, I immediately thought, okay, what's the difference between doing that and taking out a loan against your 401k account? So there's no penalty, there's no kind of comparison between taking a loan out against this policy versus taking a loan out other than, I believe the maximum in your 401k, I believe is maximum you can take is $50,000.
I think you're right on that amount, on the 50,000, and you have a little less control in that scenario because they require you to put it back within a certain time frame too. I believe it's 5 years. And that's, so the difference would be, Janelle, is first off with the 401k, when the money comes out and you're using it on whatever you use it on, you are no longer earning a return within the 401k on that money. It's out of the account. The other thing is, just as we mentioned, you are subject to the limitations and the restrictions they place on that loan. You've got to get the money back within a certain time frame and only a certain amount. So where this would be different and distinct is that you can, let's say you have 100,000 in cash value, you can use that 100,000 if you want. And when you take it and use it, the account is still earning the full dividend that year as though the 100,000 is still parked there. Now, the insurance company does charge you interest on your policy loan. However, they're still crediting you that full dividend, and it's compounding, and your policy still has guaranteed upside each year in spite of the dividend. In other words, if they weren't paying a dividend, it would still, the account balance would still rise that year. All of that growth continues to take place even when you're using the money through the policy loan. And so again, you don't have an opportunity cost there, and you're still building two assets at the same time. Your money's working in two places at the same time for you. So you'll actually experience, I don't know how else to call it, you'll experience a little bit of interest arbitrage when you use your dollars because of the fact that they're still earning a compounding return in the account.
Thank you.
I will say one more thing to that point, and then it sounds like there's a good question coming.
Yeah. Yep.
Also, Janelle, in retirement, one of the things that's unique about this insurance as an asset class is the older the asset gets, the more lucrative it becomes. And let me see if I can find the page from the presentation I shared with you guys. I don't know if you noticed, but I shared that she had like a starting balance of, it was in the neighborhood of right under $1 million, but she pulled out 1.6 million in income. So how the heck can you start with an account with $1 million in it and take out 1.6? And it's because the dividends at that point are 5 figures a year. So you might have withdrawn 82,000 that year, but your account only drew down by 30 or 40. So your money literally lasts longer and goes further. It's quite unique. So that's the other thing when it comes to traditional retirement accounts versus this, which I'm not knocking traditional retirement accounts, because most of us, if you had an employer, you're getting a match, and there's some good reasons to do that. But a traditional retirement account will accumulate money very efficiently. It does not distribute money efficiently at all. You will not get out what you have in there unless it's a Roth and unless you can avoid the downside. But life insurance is the exact opposite. It takes a long time to accumulate. It does not accumulate in a very sexy way. But when you start taking money out on the back end, it distributes extremely efficiently. So much so that you get out more than what was sitting there. It's just very unique in that way. All right, somebody else had a question.
Hi, Adam. I have a question.
No,
Oh, go ahead, Vinky.
I have a question on one of your slides, towards the end when we are receiving the money back, like you had 85 grand every year that you're getting back. How you're getting that back? That's you have accumulated already. That's like the interest on 1.6 million. How does that work?
Yep. So that 85,000 was the software that the insurance companies provide us allow us to create an income scenario in retirement saying, hey, based on the amount of cash value that's in this policy, how much could we safely take as a loan each year for a certain period of years? So we tell the software we want age 71 to 90, or we could say age 75 to 85, whatever scenario we want to illustrate. And it will tell us, here's how much you can take in a loan each year and never pay the loan back. And so, and they build in a margin of safety as well, Vinky. They have a good idea of when we're going to die. They have actuarial science down to they have it down to a fine tooth comb. But they do build in some margin in case you would be one of those few that would live, an extra 5 or 6 years after their forecasted date. So with that being said, they set you up where you can conservatively take loans, not pay them back. And the reason you can do that is because your death benefit is more than the cash value that you've accumulated. So what they'll do is, let's say you took out the 1.6 million, like the scenario I showed you.
Mm-hmm.
She had a death benefit of a little over 2.5 million. So when she dies at age 90, they take that 1.6 that she took and never returned, and they shave it off the death benefit. And now there's 900,000 remaining, and that amount goes tax-free to her family. So those dollars came from policy loans that we didn't pay back.
Okay, but the loan that you're taking, the 85K, so you're paying some interest on that?
Yes, but you're not. There is interest due, but you're not going to pay it. You're going to let it accumulate and rack up, and the death benefit will take care of it.
Yeah, because it's going to get deducted from the death benefit.
That's right.
Because it's getting cumulative. So
right.
The cumulative is going to be 1.6 when you're taking 85K for a number of years. Like I don't recall how many years you said, 85 to 90, 5 years?
It was from 71 to 90.
71 to 90. So that will make 19 years almost, right?
Yep.
So in 19 years, the interest is accumulated. So basically you did not, how much did you take out then, and how much you extra you're giving back? That's what I was wondering. And the interest that you never got, right? Either the death benefit or upfront either.
Let me pull up the slide.
Let me see. So if we do 85K, because I don't know, I'm really interested. I know we talked about that before, but never got a chance to.
Yeah, so let me do screen share real quick, Pinky, and we'll make sure we get your question answered. And if I don't answer it to your satisfaction tonight, I'm always happy to talk offline, but it's a good question. Okay. So here's the one we're talking about. Okay.
Yeah. Mm-hmm.
From age 71 to 90, she can take a policy loan in the amount of $85,783, not pay the interest, not pay the loan back, and she can do that for 19 years, which means she will pocket 1.6 million from this asset. Okay. There's a death benefit on the asset that is considerably more than that. It's built up to over 2.5 million. Because I know that even when she passes on and she has not returned any of these dollars and she has not paid any of the interest, there's still this much death benefit that's going to pay out to her family. So somewhere in there, I haven't addressed the question that you're asking. So can you help me understand where I'm not filling the gap?
So you were saying that total death benefit, I mean, is going to be 2.5 million, right? If we take that and 1.6 million, we took out in the, time frame of 19 years, 85K every year, because that's what we thought we can pay ourselves. So, and then you say the interest you never pay, it gets accumulated, that has been taken from the death benefit. So let's say even the 5% interest on 1.6 million, that's going to be taken out of 915,000 at the end. Where would that?
The 915,000 is a net number.
That's the net number. So how maybe did the interest go? That's what I was trying to understand. Or is it already included? Yeah, or is already included in the 85K? Because see, when you're taking a loan, you have to pay some interest, right? And you say you do not pay it every year, you accumulate for 19 years. So how would they calculate that? Or is it like something to be concerned about?
So the insurance company charges you simple interest, annualized.
Mm-hmm.
But what I'm saying is when she's taking this money out as tax-free retirement income, as policy loans, she's literally pocketing that $85,783 a year, and she is not sending a dime back to the insurance company. And when she dies at age 90, there is enough death benefit remaining to cover all of that 1.6 million in loans, all of the interest that she accumulated that she never paid, And still, even after that, there's $900,000 of tax-free income remaining for her family. Does that clear it up a little bit?
So when you're taking, let me ask you this question again. So when you're taking this loan, 85,783 every year, you're not paying any interest on that. That's what the question.
Correct. You can allow the interest to accumulate. You do not have to pay it because it's your policy and you can choose what you put back or what you don't.
Okay.
You do not have to pay it.
Okay.
Sonia asked, this is also called infinite banking, correct? Infinite banking would be what I showed you where we're buying the real estate deals. We're using it as capital.
Got you. Thank you.
And then James asked, can you show the slide again that compared Roth IRA? Yes, I can. I'll do that real quick. And then I want to give you guys a chance to get to your networking too. Although these are really, really good questions. Thanks, guys. All right.
It's a really good presentation, Adam.
Yes,
Thanks for sharing.
So Erickson had asked, what is divided growth usually? And when have you take a loan, how does that change the dividend?
Let me see if I can find chat. I didn't understand that, Aaron. Can you ask me again?
Erickson asked, what is the dividend growth usually? And when you take a loan, how does that change the dividend?
Okay. Loans do not change your dividend if you work with the right type of company. There's two things. I'm going to hit the second part of the question first. I only work with mutual companies that will pay you the full dividend even when you have outstanding policy loans. Not all companies do that. There are only a small handful. I work with those companies. Now, to the first part of the question, what does the dividends look like each year if I'm understanding it correctly? And I'm going to really super simplify that so we don't spend a bunch of time on it. Here's what you can count on getting out of the accumulation of your policy. You're looking at essentially having a tax-free 4% interest savings account. Give or take a fraction of a percent, it is a 4% interest savings account. Insurance companies play around with all sorts of dividend numbers to try to market better than the next guy and to keep it super short and simple. And happy to have an offline conversation, if you want to go more into the weeds. An insurance company A could have a 6.1% dividend, and insurance company B has a 4.5% dividend, and you could still potentially get better cash accumulation with the 4.5% dividend if insurance company B controls their expenses better than insurance company A. So don't be a sucker for dividend rates. It's a marketing tool that insurance companies use. It's best really to work with somebody that understands the different companies, how they operate, how they control their expenses, because they're essentially all offering the same suite of products and they're all paying the same rate of compensation to whoever's marketing those products. So they got to find ways to market. And a lot of times they'll play with dividend numbers and try to sell people on that. I'll just tell you, it comes down to more than that. Great question though.
Okay.
Adam, if I ask one last question regarding to the loan or the loan to yourself for the infinite banking portion, from the time when I'm recalling it several years ago when I actually spoke to somebody about this, from what he had informed me is that you pay yourself an interest for the money that you actually borrow from your, and so that interest you're paying yourself could be as generous or as modest as you want, but it goes back into your own life insurance. Is that correct?
Yes. So I don't create confusion, because Vinky and I were just talking and I said, you're going to take loans and not pay them back. That's retirement income. Prior to that time, when you're buying assets, just as you would do with your savings account or wherever you keep your capital, you're going to put the money back over time because you're going to need it to be there when it's time to buy the next deal. So it's important to have that discipline of paying yourself back. Greg, I don't want to spend any more time on that just because I know everybody's trying to get to the networking part of the meeting. So here's what let's do is we can have another conversation on that offline or during the networking and get into more details about, well, how do you know what to charge yourself and that kind of stuff.
All right. Well, thank you, Adam, so much, man. Great presentation. Thank you for thoroughly answering the questions. And, you know, from our attendees, thank you so much, man. Great presentation. And I think a lot of us learned a lot today.